Most investors spend too much time on decisions that barely move the needle. They analyze headlines, track daily price movements, compare dozens of strategies, and react to short-term volatility. Yet when you look at long-term results, a small number of decisions usually explain the majority of outcomes. That imbalance is where the 80-20 rule quietly operates. Hello, I'm Max, and if this content helps you approach investing with more clarity and less noise, I invite you to like and subscribe. Here, we talk about money calmly and with perspective, focusing on systems that work over time rather than tactics that create stress. The 80-20 rule, often called the Pareto principle, suggests that roughly 80% of results come from 20% of actions. In investing, this principle appears repeatedly. Asset allocation often matters more than stock picking. Consistency matters more than timing. Costs matter more than short-term outperformance. A few structural choices shape long-term wealth far more than daily activity ever could. Consider portfolio structure. Deciding how much to allocate between equities, bonds, and cash influences volatility, growth potential, and long-term returns. That single decision may account for more performance variation than any individual stock selection. Yet many investors spend their energy analyzing individual companies instead of clarifying allocation. Costs are another example. Expense ratios, trading fees, and taxes quietly compound over decades. Reducing investment costs by even a small percentage can materially improve long-term outcomes. This adjustment requires minimal ongoing effort, but its impact is persistent. It is a clear example of a small action producing disproportionate results. Consistency may be the most powerful 20% factor. Regular contributions, automated investments, and disciplined reinvestment of dividends often explain the majority of portfolio growth. Market timing, by contrast, tends to contribute far less than people expect. Missing a few of the strongest market days can significantly reduce returns, which is why staying invested frequently outperforms constant repositioning. Diversification also fits the principle. A broad, low-cost index fund can provide exposure to hundreds or thousands of companies. That single decision captures economic growth across sectors and regions without requiring constant monitoring. Instead of spending hours researching individual securities, an investor can allocate time elsewhere, trusting the structure to perform over decades. The psychological component should not be ignored. Spending less time reacting to markets reduces emotional errors. Many costly mistakes, panic selling, overtrading, chasing trends, happen when attention is excessive. By narrowing focus to the few variables that truly matter, investors not only save time but also protect returns from unnecessary disruption. The 80-20 rule does not suggest ignoring your portfolio. It suggests prioritizing intelligently. Identify the small number of actions that create lasting impact: asset allocation, cost control, contribution rate, and diversification. Once those are in place, the need for constant intervention declines. In the next part, we will examine how to practically apply this rule, what the essential 20% of investing decisions looks like in a simple, realistic portfolio structure designed for long-term results. Because investing becomes more efficient not when you do more, but when you focus on what truly matters. If 80% of long-term investing results come from a small number of decisions, the natural question becomes practical: what exactly belongs in that essential 20%? The first priority is asset allocation. Before selecting any individual investment, decide how much exposure you want to equities, fixed income, and cash. This decision determines the overall growth potential and volatility of your portfolio. For example, a younger investor with a long-time horizon may allocate a larger portion to equities, accepting short-term fluctuations in exchange for long-term growth. Someone closer to retirement may shift toward a more balanced allocation to reduce volatility. This single structural decision often explains more performance variation than anything else. The second priority is broad diversification through simplicity. Instead of building a complex portfolio of many individual stocks, many investors can achieve effective exposure using one or two low-cost index funds or exchange-traded funds. A global equity index fund combined with a broad bond fund already captures thousands of companies and multiple economic regions. That level of diversification dramatically reduces company-specific risk without increasing management time. The third high-impact factor is cost control. Expense ratios, trading fees, and tax inefficiencies may appear small in isolation, but over decades they compound meaningfully. Choosing low-cost funds and minimizing unnecessary transactions requires little ongoing effort, yet it permanently improves long-term returns. Reducing friction in the system is often more powerful than chasing marginal gains. The fourth critical element is automation. Setting up automatic monthly contributions ensures consistency. Automation removes the emotional component of deciding when to invest. Instead of attempting to time the market, capital is deployed regularly. Over long periods, this approach smooths volatility and reduces stress. Automation turns discipline into a system rather than a daily decision. Rebalancing, when done periodically and calmly, completes the structure. Markets move unevenly. Over time, one asset class may grow disproportionately and shift your risk profile. A simple annual or semi-annual rebalance restores allocation targets. This process requires minimal time but protects the portfolio from unintended risk drift. Notice what is missing from this essential 20%. Constant news monitoring, daily price tracking, and frequent portfolio changes rarely improve long-term outcomes. They consume time and often increase emotional reactions. The 80-20 approach accepts that most of the market's movement is noise, not signal. Another overlooked advantage of this framework is mental clarity. When you know that your portfolio is structured around diversified exposure, controlled costs, and automated contributions, the need to intervene declines. Time that would have been spent analyzing short-term fluctuations can be redirected toward increasing income, improving skills, or enjoying life. Ironically, reducing time spent on investing can improve results by reducing behavioral mistakes. The goal is not to eliminate engagement entirely. It is to concentrate attention on structural decisions that genuinely matter. Once those foundations are built, maintenance becomes simple and infrequent. In the next part, we will explore the psychological side of the 80-20 rule, why doing less often produces better long-term results, and how to resist the urge to overcomplicate a system that is already working. Because efficiency in investing is not about speed, it is about clarity. The hardest part of applying the 80-20 rule in investing is not understanding it. It is trusting it. Many investors feel uneasy when they are not actively doing something. There is a subtle belief that effort must be constant to be valuable. If markets are moving, news is changing, and other people are reacting, doing nothing can feel irresponsible. Yet long-term investing rewards restraint far more often than activity. Consider two simplified investors. The first checks the market daily, follows financial media closely, and frequently adjusts positions in response to headlines. Decisions are made with good intentions, but often under emotional pressure. Gains may be captured occasionally, but losses from mistimed exits and entries accumulate quietly. Over years, transaction costs, taxes, and behavioral mistakes erode performance. The second investor builds a diversified portfolio, automates monthly contributions, rebalances once or twice a year, and rarely reacts to short-term volatility. Time spent managing investments is minimal. Attention is focused on career development, income growth, and maintaining a consistent savings rate. Over a decade, compounding works steadily. Fewer emotional decisions mean fewer costly mistakes. The difference between these two approaches often becomes visible only after years. In the short term, the active investor may appear more engaged and even more sophisticated. In the long term, simplicity frequently outperforms complexity, not because markets are easy, but because human behavior introduces friction. The 80-20 rule also applies to personal energy. Monitoring investments constantly consumes cognitive bandwidth. It increases stress during downturns and encourages comparison during bull markets. By narrowing focus to allocation, cost control, automation, and periodic rebalancing, investors protect not only returns but also mental clarity. Another important layer is income growth. Increasing earning capacity and savings rate often has a larger impact on wealth accumulation than optimizing portfolio details. Negotiating salary, building skills, or developing additional income streams may influence long-term financial outcomes more than marginal investment tweaks. This is an often overlooked 20% factor. Investing efficiently frees time to focus on areas that accelerate capital formation. Patience becomes the central discipline. Markets will experience volatility. Headlines will suggest urgency. Trends will promise outperformance. The temptation to intervene will reappear repeatedly. The 80-20 investor recognizes that most of these signals belong to the 80% of actions that produce limited long-term value. None of this implies ignoring risk. Periodic reviews remain necessary. Life circumstances change. Risk tolerance evolves. Financial goals shift. However, these adjustments are deliberate and infrequent, not reactive and constant. Ultimately, the 80-20 rule reframes investing as a structural decision rather than a daily activity. Once the high-impact elements are in place, the role of the investor shifts from operator to steward. The system does the heavy lifting. Compounding replaces constant intervention. Spending minimal time does not mean caring less. It means caring precisely about the variables that matter. Asset allocation, diversification, cost efficiency, disciplined contributions, and occasional rebalancing. These are the quiet drivers of long-term results. In the end, investing becomes less about prediction and more about positioning. The goal is not to outwork the market. It is to align with it in a way that requires little maintenance and allows time to do what it does best. When effort is concentrated wisely, maximum results do not require maximum activity. They require clarity, consistency, and the patience to let simple decisions compound.